And I want to welcome you now to the Asia Investment Symposium that we're going to hold here this afternoon. As I said, I'm Mark Van Cott. I am based here in Kuala Lumpur, Malaysia, and I am a board member of Young Investor Society. But more importantly, I am also a parent advisor for the Young Investor Society Club here in Kuala Lumpur at the International School of Kuala Lumpur. The picture that you all see in front of you is actually in the middle is two of our students that started the Young Investor Society Club back in 2017, and that is their stock pitch presentation at the very beginning, right in the middle there. So let's go ahead and get kicked off. Let me move to the first slide. Like I said, we have a number of students still joining, so I will spend a couple of minutes to talk about myself. I don't want anybody to miss Miss Rebecca Sen as she joins us here speaking in a moment. And then I'll go through the agenda for the day, as well as I'll talk a little bit about our trivia questions we're going to have today, an opportunity to win some Starbucks coupons. So first slide, let me start off with and tell you a bit about myself. I am Mark Van Cott. I grew up in Texas. I'm an American, and I have been in Asia now for about 27 years, so most of my life overseas. I was interested in investing from a very young age. I actually started when I was 12 and bought my first stock in Apple Computer. Unfortunately, I did not do one of the golden rules of investing and hold it long term, but I learned a lot from that experience. And so therefore, I went on after college to join an investment bank in New York City. I joined a firm called Credit Suisse, and I worked there for really the next 20 years of my life until I left and really started my second career about a decade ago. And at that time, I was working mostly in Hong Kong. So I started in New York. I moved to Hong Kong with Credit Suisse. And while I was at the firm, I did 3 different jobs. And today we'll have a chance to talk about some of those as some of the different speakers come on and share their stories and experiences with you. But the first job was called mergers and acquisitions. And I did that for about 6 years. And then I joined our private equity department. And then I worked in our equities business doing something called proprietary trading. So I was actually a trader and got to cover a lot of the markets out here. I love the whole business, and I love helping students and young people learn about financial literacy. It's been a big part of my life here for the last kind of 6 or 7 years. As I mentioned, I am the parent advisor for the Young Investor Society at the International School of Kuala Lumpur, and we actually meet 4 times a week, if you can believe that. I don't know how many students out there meet more than once a week, but we have 4 a week. We have 2 middle school clubs, and we have 2 high school clubs. And the reason we've divided them up at our school is because many students have been in our program for a couple of years. Some of them start in middle school and move up to high school. So we have both a beginner and an advanced club. And so certainly, and let me just tell you, I am here for all of you students. If any of you have any questions about how to get a club started at your school, if you need support in terms of what to teach or how to teach or find a teacher, please reach out to me. I will put my email in the chat group here in a moment, and you can reach out to me. I am on Asia time, and I'm happy to reach out and help you do that. A couple more things about myself while we just get some more students on. We're getting a good group size here. I have 4 kids, and 2 of my kids have graduated from high school and moved into college now, and they're both actually studying finance and accounting. And in fact, one of them will be speaking to you all tonight because she is midway through her college career and will be working at one of the investment banks in New York this summer. My other 2 kids, all of my kids have been part of Young Investor Society. My other 2 are part of the club right now. And so I've had a lot of experience teaching lessons and helping students teach lessons. And one of the things that we do at our school is the high schoolers, once they've learned the lessons and been taught them, they get a chance to teach them themselves to the high schoolers, as many of your clubs do, and also to our middle school students. So our middle school program is run entirely by our high schoolers. That's a great opportunity for them to learn more about the lessons and about how the roles work. We also have speakers that come out and talk to them as well. So that's a little bit about me. I want to move now for a moment to the agenda for the day and explain to you what we're going to be doing today. Let me get this going. Here we go. All right. We have a slate of speakers. We have some really great speakers this afternoon for you. A number of them have spoken to us in past symposiums, or some of them have actually spoken to our groups out here in Asia. And particularly the club that we have here in Malaysia I know at least 2 of these speakers have been kind enough to join us and talk to our students. So first person will speak to us tonight is Rebecca Sen, and I'll introduce her in just a moment. She's based in Hong Kong, and she'll talk to us about alternative investing, which is a really interesting field these days. It covers a lot of new areas of the investment markets. After that, Sandipan Roy, who spoke to us last year as well, will be talking about careers in mutual funds. Sandipan is in India, and so we're going to have a chance to hear from him. Malavika Shankar will be talking to us from Hong Kong about algorithmic trading. And that is a really dynamic area of the investing business as computer programs and electronic systems become a bigger part of the markets. And so when I left the industry and working for an investment bank about a decade ago, most things were done by individual traders sitting on desks, but that's changed a lot in the last decade and will continue to change. Our next speaker after that will be Kate Van Cott, and she's going to talk to you all about careers in investment banking. For any of you who are juniors or seniors and thinking about going to college and looking for a job after college, you'll learn a lot from her about how the process works for internships, what companies look for in a student, and what you should be thinking about studying and doing if that is indeed a path you want to follow. And then we have our final speaker, will be Ala Mahand, on technical analysis and risk management. Now we're going to do something we did last year in between each speaker, which is a lot of fun. At the very end, we'll have a question by somebody who's been asked to ask a question on the Zoom, and then we're going to ask students to also type in questions and ask some questions at the end of each speaker. And we'll also have our trivia. And so we have got 5 trivia questions for you all, so be ready for that. Get to your keyboards. What we'll ask you to do is the first person to get the answer right will win a $10 gift certificate for Starbucks. And so make sure if you are the first answer and you get it right, make sure you put your name and your email address into that chat box, and we will get you that that coupon. So let's kick off. Our first speaker today is Rebecca Sen. I've known Rebecca for a couple of years now. I've never actually met her in person, but I've been online with her quite a bit. She is an analyst at Bloomberg. She's been there for a number of years, and she has worked at a number of different banks before that, including Commerce Bank and TradeWeb before this. She particularly handles something called ETFs, and she'll talk about what ETF stands for in just a moment. And she's also very active in clubs and in groups that sponsor gender equality, and works a lot with mentoring and helping women in finance, which is an area that's near and dear to my heart, as well as I have a daughter that's getting into this business as well. So with that, I'm going to turn the time over to Rebecca and let her talk to you for a second, for about 15 minutes about her area of expertise. And then at the end, we'll have some questions for that.
Thank you, Mark. Yes, I have never met Mark in person, even though he's been in Hong Kong. Sadly, I think he left right as I moved here. But you guys have a great panel of speakers today. I want to make this as engaging as possible. So if you guys have any questions, feel free to either raise your hand, unmute yourself, and just ask along the way, or use the chat box. So I'm going to share my screen. Oh, I can't share the screen.
Well, I'll let you do it.
Can you? Yeah. So as Mark was saying, my career was mainly in trading for a very long time until I recently moved into research. And it's very different in research, but the good thing is you still get to do a lot of different things and see a lot of different areas. Okay, so like Mark was saying, I think, let me know if you can't see the screen. But I think ultimately within finance, there's lots of different areas that you guys can do, and there's lots of different groups, but I'm in charge of this group called Women in ETFs. We have a lot of students that join. We have a lot of educational event. Feel free to scan the code if you guys want to join. But ultimately, we're going to start with some Trivial Pursuit to get you guys engaged. There are no prizes for this, so you have to wait for the official Trivial Pursuit at the end. I'm going to discuss what an ETF is, how to select it, and some of the trends in this area. So we did a webinar with Kathy Woods. Who's heard of Kathy Woods? Raise your hands or say yes. All right, we have a few people. Okay, so if you want to listen to the replay, it's pretty cool. We talk a lot of different sectors and areas, but it's quite interesting in terms of how she views the market and what she thinks of it. So question number 1, Trivial Pursuit. How many ETFs are there globally? Take a guess. A, B, C, D, E. Feel free to unmute or just use the chat. Nobody? It's because there's no $10 gift card, huh? C, good. Someone said C. Anyone else? Oh, B, we have a few B, C. Okay, great. C, ding, ding, ding. Good job, everyone who said C. Next, how much ETF assets do we expect by year end? 9 trillion, 12, 15, 20, 23. I see people typing. Go. E, 23. Oh, we got a good mix. Anyone else? B, good job on people who got B. 12 trillion. Where was the first ETF listed? Hong Kong, US, Canada, Japan. Oh, most people say B. Majority is B. Answer is, oh, the answer is C, Canada. A lot of people think it's USA, but it's actually Canada that lists first. Background is they tried to list in the US, regulators said no, so they went up to Canada. And then shortly thereafter, they had it. When was the first ETF listed? 1924. This is all way before you guys were born. Was anyone born in 1995? My guess is no. You guys probably all like in the 2000s. All right, we have B, D. Anyone else? C. 1990. Ooh, good job, Leon. All right, so who knows what an ETF is? If you know what an ETF is, raise your hand or say yes, put it in the chat, unmute, tell us what it is. Anyone? Don't be shy. Leon, I'm calling on you since you got the answer right. What do you think an ETF is? No answer? All right, so an ETF is ultimately, it's like, oh, someone wrote, Aditi, good job. Collection of many stocks that you can invest in all at once. Excellent. Exactly. So an exchange traded fund is ultimately a collection of stocks. It's a group of stocks. It usually tracks an index and there's a benchmark. And the reason why people like ETFs is that it's ultimately one, very low cost. So the pros are they're cheap. Management fee, for instance, on S&P 500 is only 3 basis points. And it's usually diversified. So it tracks a group of stocks. It's a basket. So as opposed to having exposure in just say Apple or Microsoft or Facebook, you can have an exposure to a group of baskets. So it's more diverse. There are some tax benefits, but we're not going to cover that. And then because it's exchange traded, it's listed on the various exchanges. And so you can get exposure to it very quickly. You can buy it at anytime the stock exchange is open, you can buy it in the morning and then sell it at night. So a lot of people like exchange traded funds because it's gives you access to a group of stocks very quickly. So for instance, instead of buying all the names in the S&P 500, all 500 names, that's going to take you a lot of time. It's going to be very costly because every time you buy the stock, it's going to, you're going to have to pay execution fees. Instead, you can just buy an ETF, which is one stock, and get access to all 500 names. And so that's really why we're seeing, ETFs really boom. Some of the negatives of ETFs is ultimately, there is tracking error. So it tracks a benchmark. So for instance, S&P 500, there's going to be a tracking difference between the index versus the product. The second thing is, of course, there's a cost. You are paying a management fee for the product. What is a management fee? It's how much you're paying the person to manage this product for you. And then limited control. The fund will ultimately, you can't control it. You can't say, I want to put more Apple stocks into it. I want to, I want to buy more Apple because I think it's going to do better. So you can't do that because it tracks a benchmark. And so you don't have full control over it. So that's very quickly what an ETF is. Do we have any questions from the audience? All right. Just in terms of like the growth, we expect that, there's more than $10 trillion in exchange traded products. You can see in Asia, we're still relatively small compared to say Europe and US. And ultimately that's because ETFs were originated from North America and Canada first, so they have the most assets. But in Asia, Japan is quite interesting because Bank of Japan, they own a large portion of the ETFs, but you can kind of see that this product is very well known and it's well used across the world. What types of ETFs are there? Anyone have any guess? If you do, use the chat, put it in. I see some people typing, or unmute yourself. But ultimately, there's a lot of different types of ETFs. You can see that there's market ETFs, there's crypto ETF, there's commodities, so like ETFs that track oil. Pretty much anything you can think of, there's probably something like that. So good job, MN. Commodities, oil ETF, gold ETF, Bitcoin ETF. There's pretty much one for everything. Now, how do you pick which one to select? As I said, there's more than 10,000 ETFs, and so it's quite difficult to know which one you want. But a good way is ultimately, one, you look at the exposure. What are you trying to track? Do you want fixed income? Do you want commodities? Do you want equities? And then from there, you can decide different types of structure. So for instance, a synthetic ETF would be something like an oil ETF. It'd be very expensive to have barrel of oils physically being moved around. And so you can do that synthetically. Synthetic means just instead of physically buying, when you go to the grocery store, you physically buy an orange or an apple. Instead of physically going to the store, you can say, you can kind of wrap it with a counterpart. But that's a little bit more technical than we'll go into. And the other things to factor then, where's the ETF listed? So you have ETFs listed in the US and Hong Kong and Malaysia and China and India. And so you get a very wide product offering that I'm sure Sandeep will speak about the India market. And then of course the performance, what type of performance do you have? And then liquidity, how easy is it to trade? And what is the total cost of ownership? So those are all of those factors that affect the fund in terms of how you select it and what you want. So I went into that on a very high level basis. So one of the really hot topics right now is video games. Who plays video games? Raise your hand or put in the chat. I see Lachan raising his hand. Good job. I know all of you guys play video games. But the thing is, like, for instance, in Asia Pacific, video games is very, very popular. So for instance, Japan leads in terms of, players, amount of money spent in there. But how does this translate into investment? So for instance, we expect that by 2025, there's going to be $200 billion worth of investment being poured into video games. So most people will play their video games on their mobile phone. Who doesn't have a mobile phone here? Raise your hand or put in the chat. Okay, everyone has a mobile phone. Impressive. But how does this relate then? Metaverse. I'm sure you guys all play video games with your friends, whether that be online, virtually. But metaverse is a very hot topic. And for instance, in the ETF space, there are more than 40 ETFs that track the metaverse space. And for instance, Korea leads with this with roughly 700 million in assets in the metaverse space. But what the metaverse isn't is the VR goggle. So who here has a VR goggle? If you have a VR goggle, put it in the chat or raise your hand or unmute yourself. No one? All right. So a lot of people often think that the metaverse is the VR goggle, but it's not. It's ultimately how you interact with your friends online and what you do in that virtual space. And so I'm sure you guys are all, played video games with your friends online. And so that's really the metaverse. And that, for a lot of people is what they think the future is going to be in terms of how we would interact, especially like, for instance, during COVID, you guys all had online classes, everything was done virtually. And so we expect that area to grow. So you can kind of see, metaverse, there's a lot of different funds and there's a lot of different companies. And the thing is, a lot of companies have recently rebranded themselves. So for instance, Facebook now call themselves, metaverse, they rebranded themselves. And just an interesting fact is, so Facebook, the ticker FB they changed to META for Meta. And they paid roughly 60 million for that ticker because the first ticker, Round Hill Ball Metaverse ETF, they were actually the owners of META, the ticker in the US. And so now they've changed to METV. And so just by changing one letter, they made 60 million, which is a lot of money for these fund owners. Another area that we expect to grow really well, for instance, Chinese tech funds. Who's heard of Alibaba, Tencent, Baidu? Put it in the chat or nod. Okay, I see a few nods. Okay. So ultimately, Chinese tech companies have done really well since November. They're up roughly 70% year to date, and we've seen a lot of growth in this area. I think Asia is quite unique in that people are quite technology intensive here compared to North America, and so a lot of people use their mobile phone more. There's more online payments, and so that's an area that we're expecting to grow quite quickly. And then the other thing is just an interesting fact is that passive, so ETFs, mutual funds, they hold a lot of, because they're in all of the index, they actually have a large sway in ownership. So for instance, Alibaba and Baidu are controlled roughly by 54% of Baidu is held by passive owners. And so that's mutual funds, ETFs. Crypto, anyone interested in crypto? Raise your hand, nod. No one? Okay, we have a question. So do you expect the metaverse ETF market to outgrow some of the more traditional market ETFs in the near future? So that's a great question. Thank you for that, Lachlan. I think the thing is ultimately a lot of companies are rebranding because the metaverse is so new that people don't know what it is. And really no one knows what it can become. And so a lot of companies are looking into this space. I think there's definitely going to be segments that will, take out traditional stores. So for instance, an interesting fact was, for instance, a lot of the luxury brand like Gucci, Louis Vuitton, they're looking at how to do stuff in the metaverse. And so for instance, in the metaverse, Gucci had a purse and the purse apparently sold for $5,000. And so if you think about it, like they literally made a purse for this guy or girl to hold in the metaverse. It's not a physical purse, and it sold for 5,000 US dollars, which if you think about it, it's quite crazy. But people are very interested in the metaverse. And so I definitely think there's potential to grow in this space. And that's why a lot of companies are spending a lot of money, research and development into this. And that's why even Facebook, they've shifted and pivoted and they're trying to build themselves into a metaverse company. So great question. You guys have any more questions? Feel free to put them in. But going to crypto, the reason why people are looking at crypto right now is ultimately crypto is considered an alternative asset class. And so the demand for Bitcoin and crypto is going to grow. So you can use it in blockchain technology. There's more application. You can use it in finance. And so the demand is going to grow, but the problem is Bitcoin, there's only a limited supply. Once they mine all the Bitcoins, that's it. So we're about 40% there. And so we expect that as the demand decreases, price is going to go up. So with that, that's about the time. I think, are there any questions from anyone?
Rebecca, I think we got a first question that's going to come in from Polkit. Polkit, why don't you go ahead and ask your question?
Hi, so I just wanted to ask about ETFs. When you look at an ETF, do you individually analyze every company within the ETF, or do you just look at the certain commodity that's being traded or the group of stocks in general?
So it depends if you're the fund manager or if you're the person buying it. So for instance, if you're the fund manager, you would actually look at all of the individual companies that are in that portfolio because you want to know what's going on, what's creating the moves and whatnot. So when I was trader, I did look at each of the individual companies that were in the basket that it tracked because ultimately you want to know what's happening, if there's any dividends being paid. For instance, in the Silicon Valley Bank, there were 588 ETFs that held that company. And so ultimately you want to know what your exposure is to that. I think now if you're looking at from the opposite end, so if you're an investor, you may or may not want to look at all of those companies because you might just say, look, I want to get macro exposure to the US. And so therefore you would invest into the ETFs. And so that's kind of the beauty of ETFs. You can go into really deep and say you look at all the individual companies, but you can also say, look, I just want a macro exposure to this, so I'm going to invest into that. Did that answer your question, Pulkit?
Yes, it did. Thank you.
Okay. I think Sam has a question.
Yeah, we got a question from Sam out there.
Okay, Sam's question is, I was reading an article on Bloomberg Terminal. Sam, you have access to a Bloomberg Terminal? I'm impressed. About an ETF with only stocks related to AI. And I was wondering the difference between index funds and ETFs. Okay, so index fund is a very broad-based term. Index fund is any fund that tracks an index. It can be an exchange-traded fund. It can be a mutual fund. So I'd say index fund, think of it as the big umbrella, and then within that big umbrella, there's lots of different products. ETF is one of them, mutual funds another one. The main thing is index fund is just a label, and then within that there's different wrappers for it. So for instance, if you think of candies, like there's lots of different candy brand, and so ETF is just one form of a candy brand, like Cadbury chocolates, for instance, but then you have other brands like Hershey, for instance. And so index fund is a big like chocolate sector, and then within that you have different categories. I hope that answered your question, Sam.
That makes a lot of sense. Yeah, thank you.
Perfect. All right, I'm 2 minutes over. So
Yes. One last question. Anybody have? We got one last question for you. Let's do one last question, and we'll jump to our trivia.
Okay, so I think Aditi put in the question. Great question. Yes, there are concerns of. Okay, so the question is, there's concern about the economy heading into a recession. How do you identify what kind of ETFs you would consider? So the good thing with ETFs is that they're ultimately an indicator of market sentiment, what investors are thinking. So a good way to track this is to track the flows. Where are people putting their money right now? Where are people buying and selling? And so for instance, the US right now, with all that's happening with the Silicon Valley Bank, we've seen a lot of outflows into financials. And a lot of people are scared that, this might lead to a potential recession. And so when you choose ETFs, you really need to look at the big picture and the different factors that I said. What are you trying to invest into? What areas do you want? What sectors? What region? And so that's why I think from a personal perspective, you want to have a diversified portfolio. And in terms of being exposed to having some fixed income, some equities, and having a balanced portfolio is ultimately what's going to be very important in terms of how your performance of your fund does. So very high level.
Yeah, that's fantastic. Rebecca, that is a fantastic presentation. I always love listening to your description of the ETF business and the work that you do over the years. Fantastic. Well, we're going to go to our next speaker now. Let me do a brief introduction of Sandeepan Roy. I worked at Credit Suisse for many years, but I never got to know Sandeepan because he joined long after I left. But he has spoken to us before. He was actually a presenter last year at our conference here. I really enjoy listening to his experience in his business acumen that he's developed over many years in the Indian markets. He's worked at Credit Suisse right now, but he's worked for ICI Securities as well there in India for about 8 years and done a number of other jobs in the equity space. And so today he's going to talk to us about mutual funds. So listen up, ask questions, and at the end, we'll have another trivia question. Sandeepan, I'm going to hand it over to you. And thank you very much for joining us again today. I assume you're in, is it Delhi or Mumbai?
In Mumbai, yeah.
Awesome.
Yeah. So thanks, Mark. Thanks for the kind introduction, and thanks, Rebecca, for a wonderful presentation that you gave. It's a very high standard you have set. I hope I really live up.
You're going to exceed mine by
the next
far.
Speaker. Okay, and good to be back. This is my 3rd year, and with that, let me try and share my screen. Okay, I have a presentation. Promise I won't bore you guys, and just let me know if it's visible. Is it? Yeah.
Looks great.
Cool. So the topic today is careers in mutual funds, and we more than often associate mutual funds with fund management. Quite rightly so. It is the business of managing money, right? So it's quite a noble profession and a popular one amongst finance professionals. One of the most lucrative professions, actually, both from a job satisfaction perspective, number of opportunities perspective, the options it opens up in your career going forward, as also in terms of the money. When you are in the business of managing money, obviously money matters a lot, and this is lucrative from that extent, from that perspective as well. So how am I not able to move? Yeah. So what are mutual funds? Given that you guys are quite savvy by the answers that you guys were giving, so I'll just maybe just quickly move over it. These are mutual funds are basically asset management companies which collect money from investors, which can be retail or institutions. They pool them together, and then a fund manager would be investing that money in various markets. It can be in stocks, in listed equities, it can be in bonds, it can be in money market instruments, it can be in commodities like gold, silver, etc. And obviously there are, not really mutual funds, but there are lots of funds which invest in unlisted equity, etc. as well. Some bit in long shorts, so futures and options, etc., as well. You can see some of the biggest fund management houses in the world are like BlackRock, which is the largest. Then you have Fidelity, Amundi, PIMCO, Vanguard. PIMCO is very large on the fixed income side, for example. Vanguard is the pioneer of ETFs and index funds in the world, John C. Bogle, and so on and so forth, right? And obviously, most of these mutual funds, after they became very large, they ventured into other alternate strategies like real estate, private equity. Interestingly, BlackRock was actually Blackstone when it started. The 5 partners that were there, and Blackstone used to do more private equity and public equity both. Then it split up, and BlackRock went on to manage the public equity part, while Blackstone continued on the private equity side, right? So that's how the evolution has been. Typical MF organization structure. There's an MD and CEO. There's a board in any company. There's a board which this guy reports to, the managing director and CEO. Then he will have under him a chief investment officer, a chief who is the guy who's managing the funds as the head of the investments team. You have the business officer who manages the entire sales and operations, sales and marketing and branding and everything. Chief operating officer who manages the entire platform. It's a very, very operationally efficient process and time-bound process, and hence operations become extremely important. And some of the most technical advancements have been actually made in this space, in the investment space, where trading terminals, broking terminals, everything works on split seconds, right? So the chief operating officer manages the entire operations bit. And then you have the chief risk officer, extremely important function again. More often than not, the chief risk officer actually reports onto the board itself, because risk has to be, an independent function and not really influenced by sales or fund management. We have the human resources officer, the CFO, the chief finance officer, and so on and so forth. So typical org structure. But the most appealing one amongst them, given the core of mutual funds is fund management, becomes the CIO, the chief investment officer, right? So the fund team, how it looks like generally is this is a very simplistic one, but this is how it generally looks like. When I was working in a mutual fund, this is how it looked like. I worked in 2 actually, and chief investment officer. Then you will have maybe you'll have a head of equities or a CIO equities. You'll have a CIO fixed income. Nowadays, ETF and index funds have become very big, actually bigger than actively managed funds, I would say. And then, so you have a dedicated team for that as well. And then you'll have fund managers under them. And then you'll have an independent research unit where you will have equity analysts, the buy-side analysts as they are called, because they're not on the sell side. Sell side analysts are the equity research houses, like Credit Suisse has a equity research team. So that will be the sell side analysts. On the mutual fund side, they are called buy side analysts. And you will have dealers who will be doing all the equity dealing, bond dealing, etc. Similar structure on the debt side. You will have, instead of equity analysts, we will call them credit analysts, because they analyze credit worthiness of various companies that they are going to subscribe to the NCDs or the debentures of, or the bonds of. And we'll have dealers. Largely, bond markets is over-the-counter markets, so dealing becomes an ever important function. And more often than not, a lot of these fixed income fund managers were dealers in their earlier avatars, for example. And then on the ETF side, again, you will have quant strategists and dealers. Quickly touching upon the other function, this is also a very important function, as I said, because while fund management becomes the most important function in the mutual fund space, at the end of the day, there is not much of differentiation between funds. Honestly, it's very easy to replicate a strategy that one guy is doing by the other company, right? You launch one commodity fund, there'll be another company which will be quick to pounce on that opportunity, launch a commodity fund or an infrastructure fund or a global emerging market fund, whatever, right? Or an ETF. So there, what becomes important, so when you have a largely commoditized market, is to have a sales team which really aggressively pushes the products, differentiates on the branding, marketing, which is headed by the business officer. You will have the operations team, which I already explained, extremely important. The CTO generally I have seen reports to the operating officer, but can report independently as well. But yeah, coming to why a career in MF is lucrative. As I said, there are lots of career options that open up in the MFs. Actually, this is one industry which grooms you up to continue with your vocation or with your passion till the day you actually die. Because investment is a lifelong habit. Mark obviously is an investor himself. He can vouch for it. That once you learn the tricks of the trade, you go on, continue with your investments forever, right? So that's what it sets you up for, and you can easily start on an independent note. Quite a few fund managers and the tribe is growing, actually have started out on their own, left the mutual funds, started on their own, floated their own alternate investment funds, and are doing phenomenally well. There's tremendous bit of job satisfaction given the intellectual stimulation in this industry is very, very high. Right, you are in the business of intelligentsia at the end of the day, right? So you're taking views, analyzing companies, poring over balance sheets. So if those things, if you love numbers, if you love understanding trends in the world markets or the economy per se, and how the implications are in the markets, this becomes an industry you got to get into. Not necessarily mutual funds, you can go into similar spaces, hedge funds, private equity, etc. But fund management is one area that becomes a golden option for you, right? So financial analyst, obviously, as I said, is buy-side equity analyst. You can be a credit analyst, fund manager. You can become an economist if economics is your core. That's where you go into. An economist can become a debt fund manager. You can become a macro top-down asset allocation strategist. You can become a fund of funds manager. If you're a quants guy whose numbers is something that you really live and die for, you can move into risk management, of course, but quant strategies, quant analyst, ETF and factor-based investment fund managers, that becomes your area, right? If you're accountant, if you like accounting as a profession, apart from fund management, you can move into fund accounting and treasury as well in the mutual fund, right? Tech, as I said, tech is big in mutual funds, given the operational efficiencies and the platform dependence for everything that they do, becomes obviously a core area for technology people as well, right? And sales and marketing, as I said, at the end of the day, too many funds and too few strategies, easy to replicate, means there needs to be differentiation in terms of brands, in terms of marketing strategies, in terms of sales strategies, product positioning, etc. And of course, that's how a sales and marketing guy can really thrive in this profession as well. So depending on your skill sets and more importantly, your preferences, your aptitude, you can choose career options within the mutual fund space itself, right? But again, coming back to it, I think fund management is the most glamorous thing, splashed all over newspapers. I think the $1 million salaries, etc., and the bonuses thereafter, etc., generally follow the successful fund managers. I've given you a few, pictures of the most prominent ones. On the right-hand side are the gods of fund management, I would say. That's Benjamin Graham, there's Peter Lynch, there's T. Rowe Price, and on the left side there are the Indian fund managers that I work with, and they're pretty famous on their own reckoning as well, right? So how to become a fund manager? I guess the must-haves to start with. You need a degree in finance, MBA, CA, CFA, economics grad. That's something that is required. CFA obviously is a very big advantage to have. Most important is to have an aptitude for investments and markets, right? So all of you, given your aptitude already towards investments and markets, you're already, prepped up for this kind of a career. Analytical skills is extremely important. You will be working with the best of the brands and always trying to find out opportunities for future returns, right? This is one industry which works on future probabilities and not on past returns, etc., right? So at every point of time, your hypothesis is on future things, probability of something happening in the future, probability of the company giving good results in the future, probability of an industry doing better in future, right? And accordingly, we invest today. So that becomes very important to have an analytical skills, right? In terms of work experience, buy-side analysts, you can work under fund managers as trainees, but mostly this is from campus. Campus recruitment is how you become a buy-side analyst from the beginning itself. Or you become a fixed income dealer in, let's say, some reputed broking houses, etc., an economist in a bank or a research house. And most commonly, what we have seen is that you become a sell-side analyst in one of the research houses, broking houses, like a Jefferies or a CLSA, etc., some of the broking houses, right? So you become a sell-side analyst, tracking sectors, tracking companies. That preps you up to become a fund manager. Become a buy-side analyst. Let's say 5 to 15 years of experience on the buy side is when you become the fund manager, right? Quant analysts are equally important these days, given these factor-based investments, ETFs, model-based investment strategies that are coming up, more passive strategies, and there obviously quant analysts become a very, very important. So your quant background, a statistics degree or a mathematics degree, obviously helps you a lot in that space as well. But it's not that only the CIOs are cool and CIOs become the CEOs. You can become a CEO of mutual funds. Obviously, investment background helps because that's the core function. But sales offers a fair probability. I can give you a statistics in India. Let's say of the top 20 fund houses in India, 12 are being managed by the erstwhile sales heads. Okay, while 8 are being managed by the fund managers, the erstwhile CIOs. Okay, but that is India. It varies from geography to geography, and US has more CIOs who became CEOs. Largely, they open their own firms, etc., and that's how. But CFOs and COOs also become CEOs, depending on the requirement of the company at that time, at whichever point of the cycle they are in. So that's where we are. Thought I'll keep it short and quick. So any questions, we'll be happy to take them up.
Yeah, thanks very much for that, Sandeepan. If Sylvia is out there, I think Sylvia was going to kick off with the first question. Sylvia, if you're there, go ahead and ask it. Otherwise, we will move to the chat box. All right, I don't see Sylvia there. Go ahead and ask questions. I have a first question for you, Sandeepan. It's really cool listening to you talk about mutual funds and the mutual fund industry after having Rebecca talk about ETFs. And in some people's view, they compete against each other a bit. What is your sales pitch for buying or holding a mutual fund as an investor over an ETF?
We love all funds.
So this is something that yeah. Actually, all strategies have their place under the sun, and in an allocation in a client's portfolio. But of course, we face this question all the time, and in today's world where information asymmetry is no more, is actually kind of shrinking, becomes that much difficult for an active fund manager to beat the index, right? So that having said that, there are active fund managers who have really done well even in today's world, right? And then the biggest example everybody takes is Warren Buffett, right? So at the end of the day, he's one of the he's an active fund manager and obviously the world's best investor, right? But if I just take him out and talk about others, actually in India you will find more Buffetts and more people who have beaten Buffett, given the way the country has grown. So it depends on where the country is and where the segment is. If we are looking at a very matured sector of the economy or of the market, let's say large caps, blue chip stocks, it's best to invest through index, not much to really find opportunities in otherwise, right? But when it comes to the hidden gems, maybe in the slightly lower market cap segment like small cap or mid cap, where there's still information asymmetry, still a lot of research that needs to be done, primary research from the fund manager or the analyst that needs to be done to find out the stories that are going to unfold in the company in the future. I think active management is still very, very important there. And the more the information asymmetry, the more important I think active fund management becomes. And that's where I think it still has its place under the sun.
Very good. Thanks for that. We're going to ask one more question here from the chat box. Aditi asked, what does the average size of a portfolio of a fund manager look like? Is there an average size?
Actually, there is no average size. Different companies are different. You will have BlackRock's, which will be like $10 trillion of assets under management. And then you'll have funds which will have maybe 50 million under their assets as assets under management, right? So there's no one size fits all answer to this question. The large fund houses have become really large as we speak. So the top 5 fund houses will all be above $1 trillion of assets under management, right? Whereas, as I said, there are n number of fund houses. It's easy to launch a fund and become a fund manager yourself. You have investors, collect money, $100 million, you are good to go, right, as a fund manager. So yeah, the large guys are becoming larger, but increasingly we are finding a lot of fund managers who have made their own name, finding their own niche and branching out on their own, managing a set of clients' money themselves.
Very good. That's fantastic. Really appreciate that. Any last question before we move on? I think, Pulkit, we got your question in my question, so we won't ask that one. Sandipan, we love hearing from you. I really appreciate you. We all appreciate you getting on there from Mumbai today to talk to us. As I said, this is your second year to do this for us. Really appreciate that. I am pleased. We're going to move back to Hong Kong. So from Hong Kong to Mumbai and back to Hong Kong, I'm pleased to introduce Malavika Shankar. She is a managing director in Morgan Stanley, the equities division there. She's been working there for a number of years. Most of her career, I think all of her career has been based there in Hong Kong. I don't know if she was on for the beginning, but I spent about 17 years there in Hong Kong with Credit Suisse. So I was just across the street from you, also in the equities department. So great to get you on here. She is working in she's the head of distribution product manager and COO. She's been at SocGen and JP Morgan as well, and runs the listed derivatives business there for Morgan Stanley in Hong Kong. So she'll talk to us today about algorithmic trading, which to me is a very mathy job. So we're going to learn more about that. Malavika, I'll go ahead and hand it over to you. If you want to share your screen, you're welcome to do that, or you can just talk, whatever you prefer.
Excellent. Thank you very much, Mark. But just to confirm, can you hear me okay?
Yes, all good.
Okay, awesome. Firstly, thank you very much for having me. I really do appreciate it. This is a subject on which I can speak of and about for about an hour, if not more, but I certainly will not do that today. What I do plan to do is sort of give you a sort of 5 to 6 minute overview, and then I do welcome questions because, we can talk about the subject in so many different ways, but I think it is particularly interesting to talk about algorithmic trading given the previous presentations around what we've heard around the ETF space, but also investment management as such and sort of more fund management, right? And because both are very, very relevant to the space of algorithmic trading. So the first thing I wanted to sort of touch upon is algorithmic trading is such a broad, real umbrella. So to give you some sense of context, prevalence, there are 2 different statistics, if you like, and that's always a good place to start in my mind as to when you look at the percentage of all trading that's done on US markets with respect to equities, right? And this is just talking about sort of cash equities, so stocks, like you guys guessed Tesla just now. So when you look at percentage of trading that's done algorithmically, i.e. using an algorithm and a name like that, you tend to average at about 60 to 65%. This is slightly dated statistics from the SEC, who is the primary regulator, but that gives you a sense of magnitude. And then a number of us are based in Asia. You could go, but how does that compare in Asia? Is the number just much lower? Is it 20, 25%? The key around Asia is that while market structure is different, what do I mean by that? When you look at participant mix, right? So retail is very active in Asia, but you do have a number of institutions, as you've heard with the previous speakers, who are active. It's surprising that in a market like China, if you look at the percentage of turnover that we believe is driven sort of quantitatively and algorithmically, that can go way up to sort of 30, 40%, even more on busier, higher volume days, right? So algorithmic trading is all pervasive, prevalent, and certainly the present, not the future. That's the first point I sort of want to make. The second point with respect to interacting with algorithms, I found Sandeep's sort of view on that and the way he explained it around how can you be a fund manager and how can you sort of be interacting with algorithms. Really, there are various components of an algorithmic design, execution, trading, and sort of usage process. But I'd say that's the first place to start, right? Designing an algorithm. And typically you have a real partnership there between someone, and we sort of call them quantitative researchers or strats. So those who have a quantitative background in being able to run, design and run models to look at patterns and ways to trade in the marketplace. And the skill set will be fairly similar if you're looking at designing an algorithm to trade in US markets versus China, but you do need to have then a deeper understanding and be able to look at the market data in each of these markets and embed nuances of trading these markets into your algorithms, right? So if you like that element of designing a model and then sort of working with technology to go ahead and implement these algorithms, and that's a natural place in which you can start. And there are banks like us who look for talented folks who can interact with us there. And there are also absolutely quantitative investment managers, right? So the biggest names that you'd hear and you've seen in the news, whether it's Citadel, Millennium, or even given we covered ETFs and things, if you look at a BlackRock or a Fidelity, State Street, a number of them use algorithms in various capacities, and a number of them look for individuals who can help them design and implement algorithmic strategies. So I think that's the first real way in which you can interact with the algorithmic trading ecosystem and universe. The second way is also to be a real user of it. So if you are going to be a fund manager, and we've talked about some of the considerations there, and creating investment returns. So once you've designed and sort of understood how you want to invest, right? We spoke about active versus passive investing, so I won't get into that. Then you look at implementing your idea, right? So if you've decided, Tesla flashed on our screen, so let's go talk about that. Say you've decided actually that you're a passive fund manager, right? You're tracking the S&P, and you're managing $1 billion that's tracked to the S&P. What you do need to do is manage around index rebalances. So the S&P changes its constituents on a frequent basis. What happens then is that those constituents are changed at closing price, right? The price at which that stock closes on rebalance day. Okay, so you're managing $1 billion. Suddenly, say Tesla's weight is going to go up X%, and you need to be buying $200 million of the stock. You need a tool, like basically, an algorithm, fundamentally, potentially, to go and help you execute on that instruction and get you as close, right, as no pun intended, to the closing price on that day. So that's where being able to have essentially a logic and a rule set to be able to implement what is your benchmark on that day, which in this case, in my example, where you're looking at a rebalance and an index strategy is actually the closing price, that's where an algorithm becomes sort of very, very handy. So you as a fund manager make that decision to go and invest or be benchmarked to the S&P. You then need to go and manage your portfolio as the index rebalances and goes in and out in certain names. And so you look to an algorithm to help you achieve that execution instruction that you're looking for and the benchmark you're looking to solve for, which is the closing price, right? So I can give you very many different examples. You know, Tesla's a nice liquid name. What do I mean by liquid? There's a ton of volume. There's a ton of sort of billions of dollars that's trades on the market on every day. It's actually but not a very hard name to trade most days. But then you look at sort of the mid-cap names, the smaller names, when you look at market capitalization, that need more sophistication to be able to trade, right? So when I talked about interacting with algorithms, you can either be involved in design and development and sort of deployment of the algorithms, or you can be, you know, interact with algorithms as a user. So you can be a trader who then works with a fund manager to go and implement that investment decision, or you can also be, you know, like a member of my team who basically works with these investment managers to then go ahead and help them find the best algorithms that we and our teams design to then go and execute in the marketplace, right? So that's another way. And the final way, so I talked about sort of you're making your investment decision. How do you then, you know, use algorithms to go and implement that investment decision? That's sort of that ecosystem one. And then ecosystem two is to be involved with someone like ourselves, or, you know, someone who helps clients go and execute in that marketplace and designs algorithms for them, because perhaps they don't want to design it and they're happy to use all the work that we've done to really make our algorithms smarter. And then we also have the final component, which is breaking down how an algorithm does, right? So we have a bunch of analytics. And what do I mean by that? Decomposing how an algorithm has done versus, for example, that close price, and then to show fund managers and their traders how well we've done to meet and beat their benchmark and therefore win more business, right? So look, it's incredibly exciting. I haven't used the buzzwords around machine learning, for example, because that in itself will be an hour's conversation. But I think that's one of the biggest things to note, in that there's continuous innovation in this space as it relates to how do you get smarter about learning how markets operate. If you've been following the news, if you've been looking at all of the volatility that we've seen recently, right, in the US, you need to be able to respond as markets trade differently to make sure your algorithm incorporates that information, right, and then responds to that information by trading differently. So that in itself is an art, and machine learning can help with something like that. And also we're getting better about liquidity, right? So in Asia, the costs of trading can be very significant to an investment manager sort of returns. So how do you use your algorithm to go and get best in class, cost-efficient liquidity for investment managers? So that's something that we think a lot about as well. So that's a lot to cover in sort of, what is that now, 6 or 7 minutes that I've taken. But I think the easiest way to do this is to shoot questions. I've only talked to you about examples in the equities markets, given we were discussing stocks, but you can use algorithms in FX. It's used a ton. It's not my area of expertise, but you can, absolutely. It's used in the fixed income space increasingly with respect to how you source liquidity in interest rates as you interact across dark pools. So that's interesting, and also the credit space. So started with equities, certainly sort of really started, you know, kind of taking off in the 80s and 90s in the US, and then now increasingly in the 2000s in Asia. But like I said, I would not think of algorithmic trading and interacting with that as the future. It is the present as far as I'm concerned. So hopefully that gives you a sense of the various ways in which to think about this space. I'll pause there, Mark, and then see if there are any questions that people are curious about.
Malavika, that's fantastic. Thank you. That's a great overview. Very well done. Our first question is going to be from Lachlan at the International School of Kuala Lumpur, actually. Lachlan, you got a question, yeah?
I do. So my question for you is, how do you see algorithmic trading expanding in terms of the present as the use of AI, of course, expands with things like OpenAI and all those different AI tools out there? Do you see there being a higher amount of money spent in that sort of space, or how do you see kind of it expanding as AI grows?
Yeah, absolutely. Look, this is something we think a lot about, right? So AI for me, and that's why I sort of mentioned the whole machine learning sort of area, it is a significant way in which we make our algorithms smarter. So the first, you said to me, how do you see it expanding, and do you see it expanding? I absolutely see it expanding. Now then the question becomes how. It is when we look at the other asset classes that I mentioned, they tend to be more complex to trade. So think about how a Tesla, an IBM, or an HSBC stock trades, right? You can look up a price. It's all on exchange. It's lit liquidity. It's what we call lit. It's discoverable. Whereas if you look at more of the fixed income markets, when's the last time you heard of an exchange for fixed income sort of markets as in general, right? So it tends to be more opaque. So to navigate that opacity and sort of being able to interact with different venues, that's where using something that's a little bit more complex for algorithms to learn how to trade each of these venues, that makes it very interesting as well. By the way, we won't go into sort of all things alternative investment and sort of cryptocurrencies and things, but algorithmic trading is absolutely used to deploy strategies there as well, right? So it's pervasive, I think, in the way, if you haven't figured it out, Spotify uses an algorithm to figure out how to create your song collections, right? So I feel and believe and know that algorithms create pretty much everything that we do use today in terms of various facets of our lives. In finance in particular, my short answer to your question is yes. I think ways in which you can think about using, so if I, for example, if I'm an investment manager and I go, hey, I'm a broker, right? So Morgan Stanley, for example, is a broker. It's a big fund manager. So for clients to just say, hey, I just want to buy $1 billion. I know that this stock only trades $10 million a day. You figure it out. You figure out how many days you want to trade, how many months, keep it as long as you want, but just give me a return. Maybe that day will come in the future. We're not there yet, but I'm very, very optimistic about the kind of technology we have and our ability to use that to innovate.
Thank you.
Fantastic.
No
Thanks for
worries.
that, Bachman. Thanks for that, Malika. Malavika, I got a question for you. Actually, we got a question in here. Good. That's very similar to my question. All right. So Aditi asks, what kind of higher education helps you enter professions in algorithmic trading? I think you majored as an undergrad in economics, correct?
I did. So basically tells you that you can do anything and come into algorithmic trading. Look, I'll tell you one thing. So I work actually across our internship programs, and I sort of chair what we do here at Morgan Stanley for our equities business. The first thing I will say to you that what matters if you're going to have a career in finance is a passion for finance, right? Read the news, show interest. It's about logical thinking. It's about being able to construct robust arguments. Everyone can do that. And I'm sure everyone on this call is passionate enough to make time an evening, morning, depending on where you sit, can do that. So I could sit here and say to you, oh, you must have a PhD to come and do what I do. Clearly not, right? You've seen my background. So first, demonstrate a passion for finance, a real time spent understanding markets, what moves markets, what drives sort of investors, and what makes an investment decision viable versus not. Those principles do need, you need to have a foundation in that, and that can really come from reading or learning, as some of you all are in university as well, and deploying courses. So that's the first. But second, that's why I sort of spend some time talking about the various ways in which you can interact with algorithms. So let's take me. I have an economics background. I did some math and econometrics, but I absolutely am not qualified enough to go out and design algorithms myself, right? You need to be able to have a background in statistics. You need to be able to express, models and be able to interact with the latest technology around machine learning, for example, and really build deep dive and customize around how you build. So I don't have that. Neither can I code. So I'm not going to be able to either design or sort of develop and implement an algorithm. So really, you should have a think about what drives you, I think. If it's about working with clients, building relationships, being able to sell a product, a lot of what I mentioned, showing passion, being able to learn, being able to ask the right questions, and then, being able to go into some depth quantitatively to be able to explain an algorithm is sufficient, and you can build a career from there and learn on the job. If you want to be more involved with the design and implementation side of things, you will need a background in coding. You will need a background in statistics, right? You're better off doing something like a quantitative finance or a master's degree. A number of our strats have that, for example. So I'd say have a think about that and the bifurcation, and then you can sort of think about the degrees that would help.
Yeah, Malavika, that's really great advice. I completely agree with that, students. As you think about finance, think about whether or not you like reading the papers and studying and understanding what's going on in the markets today, whether or not you're excited about, the different areas that you can study in this. Think about college. If you go into college, you want to take finance class or econ classes or things like that. I think those are all really, really important to figuring out whether or not this is an industry you want to pursue later in your life. That was fantastic. Thank you very much for that. I assume you were at work today on the trading desk somewhere.
Yeah.
That was Awesome for you to take time to talk to us today. And Malavika's discussion at the end there about things that identify someone who's interested in these areas is going to segue really well into our next speaker, Kate Van Cott, who's going to talk to us. She is a college student actually in university thinking about going into investment banking. But before we get to that, I am going to switch over and we're going to ask our next question. So Malavika, thank you very much for that. Let me go back to our presentation. Fourth speaker, and this is a speaker that I know very well because she grew up in my house. Kate is a junior right now studying accounting and finance at Brigham Young University. Kate actually started our Young Investors Society chapter at ISKL in 2017. She had a friend in Hong Kong that was doing it. She found out about it and decided she wanted to start a club here. She had a really cool chance to fly back to Dallas and to meet Mark Cuban as part of the Shark Tank competition. So for those of you that have not yet participated in Shark Tank, please do so. It's a cool competition. She is going to be working at Lazard this summer in New York. It's an M&A boutique, as we call them. And she's had a number of different opportunities to work at different internships in her freshman and sophomore year. So Kate today is going to talk to us about a career path to investment banking. If you are in high school or in college, which all of you are, this is a fantastic topic to spend some time and listen to about really what do you do next? Very close to people your age. What do you do next as you move into this field? So Kate, if you are on there, I know, by the way, Kate is in Utah. So I think it's 4 a.m. for her, and we really appreciate her getting on. Kate, I'm going to go ahead and hand it over to you, and you can share your slides.
Okay, can you see my screen? And can you hear me?
I can hear you just fine. The screen said it started to share, but I don't see it yet. Let me see. Give it one more shot. And while Kate's,
did you share it on your end?
Yeah, sure. What do I need to do?
Just share your screen. I sent the deck to you earlier.
Oh, did you? On my computer or where?
To your Gmail.
To my Gmail. Okay, if you can send it to my, while I'm pulling it up, pull to my chat group. I'll pull it up. You go ahead and start talking and I'll get your presentation here.
So I can just give a quick intro to myself. I know my dad just gave me a little intro, but I'll just add on to a little bit more. So I'm at BYU right now, in Utah studying accounting. I am a junior there, and then headed to an investment bank this coming summer. And then after I finish my senior year of school, I'll be headed back there, hopefully, full time. And today I just wanted to come give a little primer on what investment banking is, because it's, like, in my opinion, I think it's a great career choice for students who are looking to not just develop skills in finance, but to learn more about the industry and then maybe even pivot into other roles in the future. And investment banking is a great platform to do that off of. So I can go, okay, while we get the slides up, I'll go into my background a little bit more. So I graduated from ISKL in 2019 and then came to BYU, where I've interned at a bunch of different places. A couple that come to mind. So I've interned at this tech venture capital firm called Elevation Capital here in Utah. So happy to answer questions about venture capital. Or yeah, here we go. And some of the logos are up here. I've also interned at Logan Growth Advisors. They were a healthcare M&A team. And so I did that for full-time for a semester as well. And then most recently, I interned at Partners Group doing private equity. So I've kind of had experience both in like private buy side and then investment banking as well. And happy to like answer questions about all of those, even though today I'll be talking primarily about banking. So just to go into investment banking and what that is really quick. Investment banking is primarily a financial service that you provide to other companies. And so banks will get together teams of people to represent companies that are looking to, one, buy other companies, two, companies that are looking to sell themselves. And then the last one is companies that are looking to raise money, whether that's through debt or equity. And so as an investment banker, you basically work on behalf of these companies to help make those transactions happen. And that is kind of the nature of the job. So going into kind of the investment banks that are out there, there are two main types of investment banks, bulge brackets and elite boutiques. And so bulge brackets are these large banks that provide a lot of services that you guys have probably all heard of. So Goldman Sachs, Morgan Stanley, JP Morgan, these are all examples of bulge bracket banks that are really popular for lots of kids to go become investment bankers at. And then on the other side, we have elite boutiques. And the reason they're called boutiques is because they're a lot smaller and specialized mostly or only in financial advisory services. And a couple examples would be the place I'm headed to this summer, Lazard. Another one would be Evercore. And then these are typically in like Moelis and Centerview. And these are typically like less well-known. But if you're in finance, you'll get like adequate exposure to kind of all of these banks. And then going into kind of industries, sorry, one sec. Hey, Dad, did you get the slides up or no?
Yep, I think, can everybody see them or not?
I do not.
Oh, let me try again. Sorry, I thought the slides were up.
No, you're good. Okay, so investment banking, you represent companies that buy other companies, companies for sale, things like that, right? And so the companies that you're working with can range across like a huge variety of industries. You can work on teams that work only with healthcare companies, only with technology companies, real estate, consumer companies. This like upcoming summer, I'm hoping to do some work with industrial companies, so companies that do like manufacturing and mining. And that's kind of something that I'm excited for. And then not only are you able to work on teams that focus on specific industries, you can also work on teams that focus on providing specific services. So a lot of banks also have M&A teams, so mergers and acquisitions teams that solely work on the process of helping facilitate the sales of companies or the buying of companies. And so that's another option as well.
Sorry, tell me, can you see the slides, everybody?
I can see them now.
Okay, good.
Yeah, you're good. Okay. So yeah, jumping into recruiting. So recruiting is something that happens pretty early on in college. So it's great that you guys are kind of here starting to learn about investment banking and what that is. So when you get into investment banking as a college student, typically that means interning for one summer after your junior year. So you can kind of test the waters and they can see what you're like before going back there full time. So the process starts like, before you graduate. And for some, it can start as early as your freshman year. And what that timeline looks like is you recruit in the winter semester of your sophomore year. So this is about 12 to 18 months before you'll intern there. So they do start pretty early. Then you'll go intern there the summer after your junior year and then return full-time after graduation. And when it comes to being a competitive candidate, they're like the main factors that come into play would be kind of these factors listed here on the right. So your resume, networking with bankers and networking with other people at your school that are going into investment banking, any work experience that you have. So I only listed like internships, but I've taken, several classes that are applicable to investment banking and competed in case competitions, like valuing companies and presenting like solutions to case studies. Another thing would be technical knowledge, your personality fit, and kind of that ties into your interview skills as well. And so these are all things that you'll spend some of freshman year and a lot of sophomore year working on while you go through that interview process. And the interview process typically looks like sending in a resume once the application opens and then interviewing anywhere from like 3 to 10 times, depending on how competitive it is to get into that bank. Okay, could you go to the next slide? So one thing I wanted to talk about here was how Young Investor Society helps prepare you for investment banking coming out of high school. So I think that my experience doing YIS in high school was one of the primary reasons that I was able to kind of succeed in that recruiting, like throughout the recruiting process and also within my school's like investment banking ecosystem as well. My school's an investment banking association, and most of the recruiting is done through there. And you'll see that's really common kind of with all schools. And the thing about YIS is that it preps you for so many different parts of the recruiting process. And honestly, like it kind of helps build all of the components that go into recruiting. So YIS, like the CYIA and the stock pitch competition, these are great things to get on your resume. YIS can be something that you add into your like story. The story is kind of like how you tell people like who you are and how you got there. And a lot of times YIS can be a jumping off point for an interest in finance. It provides like work experience, again, like tying in with the resume, technical knowledge. I mean, you guys just answered a trivia question that I don't think that most high schoolers would get. And so that's definitely a jumping off point for starting to develop that technical knowledge about like what is finance, what is banking, and like kind of doing the math behind that. Personality fit wise, you're able to meet a lot of other people that are interested in finance and learn about like whether or not that fits your personality. You're able to learn about all these different careers out there and see which one's kind of best for you. And without YIS, I think I wouldn't have known that investment banking was the part of finance that I wanted to go into. And so kind of that's also a really helpful like indicator as well. And then lastly, networking, because you guys are in a club with a huge network of students, not just like within your club, but at other schools as well, and professionals who've like graduated from those programs. And I think that having that Young Investor Society tie to all these other people across the world, across industries, can be really helpful when it comes to breaking into other spaces and trying to get to know more people as well. So love that all of you guys are doing Young Investor Society, and highly recommend immersing yourself in that experience if you're trying to get into finance and especially investment banking. Yeah, next slide. Okay, so this is just really quickly on what being an investment banking analyst looks like. So it's typically a 2-year program, and down here you can see the progression that people take in their investment banking careers. You'll go from analyst for 2 years, sometimes 3, to associate for a few years, vice president, and then eventually to managing director. And managing director is where you are bringing in transactions for the firm to work on, and you're kind of leading that whole process. And so as an analyst, you get a lot of really valuable experience. You get first exposure to management. You'll be working on teams with, you know, a vice president and a managing director. And these are super high level people who've been in the industry for forever. So you'll be able to kind of gain skills from your interactions with them. You get to work on high profile deals. I know a friend of mine, he was working at Barclays in San Francisco this past summer, and he was able to work on deals for DoorDash and Uber and Meta, and he had a great time doing that. And that was just as an intern there over the summer, and was able to, you know, visit all of their offices in San Francisco just by working on those deals. You learn valuation skills and attention to detail. A lot of your job is kind of creating materials and financial models to help facilitate to help back up the numbers behind the sale and facilitate the sale. You also get exposure to basically the industry and just learn a lot about the industry. And that brings me to my next slide. And it's kind of about all the opportunities that you get coming out of investment banking. So investment banking is a great career, and I hope to do that forever. But it also serves as a great jumping off point for a bunch of other careers, including kind of some of the careers that the speakers that we had today have pursued over the years. So after you finish your 2-year program, a lot of banks will then send you, like, either you'll stay there and you'll continue on in career in banking, as we have on like the left-hand slide, or you can kind of go pursue other opportunities. And these other opportunities, they're actually what most investment bankers pursue after their 2 years as an analyst. So a lot of people will go to the buy side in private equity and venture capital, and that's where instead of facilitating transactions, they become the buyer in those transactions, and they become an investor. A lot of people will go to the operations side and do corporate development or strategy. And that can be a really fun thing to do in-house for these really large companies that just look for people with a financial background like you develop after your investment banking analyst program. And then the last thing to do would be business school. Investment banking, it's a really intense career, so it prepares you really well for like applying to business school, but then also applying yourself rigorously within those curriculums. And so kind of what I'm trying to say, and just to sum it all up, is that investment banking is a really like colorful and intense experience for someone who's like just coming out of college. You get a lot of responsibility, a lot of opportunities to learn, and a lot of like you'll spend a lot of time developing your skills. And this is a skill set that, like as you can see on this slide, is coveted by a lot of different like companies across like a multitude of different spaces. So even if you're not 100% sure where you want to end up in like 40 years, which I think is true of pretty much everyone, investment banking analyst programs are a great place to start off in. And you definitely can't go wrong coming out of one of those programs. So yeah, I'm happy to take any questions or answer questions about like recruiting or investment banking or private equity or venture capital.
Hey, thanks very much for that. While we get questions up here, and I see some coming in, I'm going to flip up to these slides that we missed because as an old guy, I'm still working on Zoom sometimes. All right, we got a question. First question, a DTS. Are there specific types of classes you should take at university, Kate, to help build your skills needed to be an investment banker? What do you think about that?
So investment banking, they will take students from any major, and they do value like backgrounds across like a diverse set of backgrounds. For example, if you look at the industries right here, healthcare, for example, if you're working on healthcare deals, they'd be happy to take like a biology major because they kind of know the product, they know what's going on with those companies. But some key classes you should take are definitely any sort of intro finance classes. Most of the concepts that you'll have to know going into investment banking will be touched on there. But other than that, honestly, these banks are just looking for people who are willing to learn. When you do your internship, that's when they'll train you. Even at the start of your internship, they'll typically do a week of just like pure training. And what they're looking for is just demonstrated excellence in school that they can take and turn into kind of an investment banking skill set. So it is definitely helpful to take finance classes, but if you kind of learned about investment banking later on, or you didn't like you're interested in other things as well, it's totally okay to not come from that background and still succeed in investment banking.
Awesome. Thanks for that, Kate. Okay, we're going to have a question now. Bikashini is on as well and has a question for you. You can go ahead and join live and ask.
Yeah. Hi, Kate. So I was just wondering that investment banking is a really competitive field, but it's also really interesting, but it's also not known for its diversity. So have you seen any sort of changes in the industry over the years? And also, you know, being a scholar from the Girls Who Invest, have you seen there being a change in how the industry works? Has there been more diversity, more inclusion, or is there still a long way to go for this specific field in finance?
Yeah, I mean, you can always argue that there is still improvement to be made, but I think that investment banking has become a much more diverse environment, at least like now than like compared to when maybe like my dad was working at Credit Suisse. So I actually got into Lazard through a diversity program, and those have become really popular. And actually, a lot of banks do their hiring through diversity programs first, before heading to kind of the rest of the pipeline for candidates. They will, like my bank at least aims to accept at least 33%, you know, diverse candidates. So whether that's, you know, coming from an underrepresented minority group, if you're a female, if you're a veteran, part of the LGBTQ community, banks are making a huge effort to like find candidates from those spaces. And they also make a huge effort to support candidates within those spaces after they come to work there. So most banks will have these things called affinity groups. And they're basically like these societies where you're able to connect with people that come from your background, and network with them while like you know, continue in your career at that bank. And so kind of that being said, I think that banks are doing a great job of encouraging diversity right now. There's definitely still a little bit more they can, like a little bit more to do in terms of getting a balanced pool of candidates, but kind of like a lot of effort is being put into that. And I think that'll definitely continue to improve over the next couple of years, especially by the time you graduate.
Very good. Thanks for that, Kate. Just in the interest of time, we're going to do 2 more questions, and then we're going to move to the next speaker. If anybody wants to get on and ask one out loud, feel free to do that. I'll give you about 10 seconds. Otherwise, I'll go to the chats.
Hi, Kate. I just had a quick question about the recruiting process. So I was just wondering, what was one of the hardest questions that you were asked while being recruited in out of university?
Yeah, so the harder questions, they can come in the form of modeling tests. So a lot of times they will ask you to do these like 15-minute models basically on paper. There are 2 like main questions, like 2 like types of questions that you can get, and those would be an LBO model, so a leveraged buyout model, and kind of doing the math behind that given certain assumptions, and then an accretion dilution model. And so that is basically a model that shows you what happens when 2 companies merge, and they'll give you kind of the basic assumptions for that as well. And those are probably the hardest types of questions. Outside of that, there is this book called the 400 Question Guide. And like if you just Google 400 Question Guide, I'm like that'll be the first thing to pop up, and it contains like pretty much all the questions, all the basic and like intermediate questions that they'll ask you throughout investment banking recruiting. And that's a book that, you know, like thousands of people across the world use to prepare for that. So for sure, take a look at that if you're interested in learning about kind of the technical side of recruiting.
Thanks.
Awesome. Thanks for that, Kate. I'll tell you what we're going to do, because we are a little bit behind schedule here. Kate, if you don't mind, if you're willing to put your email in the chat group, I'm sure there's some students that have some additional questions. I see some in the box here. If anybody wants to reach out to you and you don't mind doing that, there you go. There's her email. Feel free to text Kate directly. She's in college and she is working to get a job in investment banking after she finishes. So feel free to do that. Kate, thanks very much. I know it's late for you and I know that you've got tests coming up tomorrow. All right, I am going to try next and final speaker. I am very pleased to introduce Alhamande. He is a very successful gentleman who's passed the CMT examination. He's earned the CFTE credential. He is a YIS alumni and a certified financial technician. So I'm actually going to learn a lot myself in learning about these different degrees. I've had several questions already asked me by private message, if you don't mind explaining what the CMTE is exactly and the CFTE. Those are degrees that some of your fellow students would love to learn about. So I'll go ahead and hand it off to you. First, tell us where are you at right now as you get ready to talk to us?
I'm in Saudi Arabia, Riyadh at the moment.
Oh, fantastic. All right, the floor is yours. Thank you.
Thank you. Thank you for the introduction, Mark. Welcome everyone to my session. My name is Al-Muhannad Al-Saif. I have passed 2 levels of the CMT examination, and I am a certified financial technician. You can connect with me on LinkedIn or email me at almuhannad34@gmail.com. In today's very brief session, we'll be briefly covering technical analysis and its tools and risk management. So let's begin. Okay, so let's begin by defining the term technical analysis. And technical analysis deals with studying the past in order to forecast the future. And technical analysts study 2 main sources of information. They study price and volume. Price refers to the price at which investors are willing to pay to gain ownership in a company. And volume is the number of shares traded in a specific time frame. That could be a year, a month, a day, all the way down to tick volume. So this is a chart at which a typical technical analyst would look at. And this is called the bar chart. And it's one of many ways that technical analysts can display Can you hear me?
We've got you back. Okay. Yep.
So each I think you can hear me back. So each bar here represents a certain time frame determined by the investor or trader. In our case, we're using the daily chart. So each bar represents 1 day of price action. And these bars represent 4 main sources of information. They represent the opening price, the closing price, the high of that day, and the lowest price of that day. So let's take this bar, for example. The left tip here represents the opening price. The right tip represents the closing price. The highest point on that bar represents the high of that day, and the lowest point of that bar represents the lowest price of that day. Okay, so let's move on. So technical analysis is built upon three basic assumptions. And these three basic assumptions were proposed by Charles Dow. And Charles Dow is named the the grandfather of technical analysis. And in order to use the tools in technical analysis, you must subscribe to these three basic principles. So he first said that market price discounts everything. And by that, he means that the current price reflects all publicly known information about the stock. And he proposed this all the way back in the 1930s. And this was proved by Nobel Prize winning economist Fama in the 1970s and 80s, which just shows the validity of technical analysis. The second assumption of his, he said that prices move in trends. And technical analysts have defined three main types of trends. Prices can either go in an upward trend, in a sideways trend, or in a downward trend. And lastly, he said that history repeats itself. And by history repeats itself, we don't mean that what happened in September 2nd of last year is going to happen in September 2nd of this year, but rather that in order to understand the future, you should understand the past. So this is the chart. This is a chart that resembles the three principles of technical analysis. So the first principle is that price discounts everything. And although we can test this and determine whether this is true or not, we're not going to do this since this is beyond the scope of this session. The second assumption of technical analysis is that prices move in trends. And trend is subjective to each trader. Someone might define a trend as a price closing above the 20-day moving average. Someone else might define a trend as price closing higher for 5 consecutive days. But for the sake of simplicity, let's say that a trend is a prolonged movement in one direction. So we can see from mid-September until mid-December, we saw a sideways trend in Apple stock. And from mid-December until the beginning of 2023, we saw it. And from the beginning of 2023 until mid-February, we saw an upward trend, which proves our second assumption. So let me just clear everything. So before we go and talk about the risk management tools we can use in technical analysis, we should first define risk. And risk is uncertainty. And by uncertainty, we mean the actual or the likelihood of actual return to differ from the expected return. Although we can define risk in more depth, we'll just keep everything simple and basic. So there are many ways we can manage risk and technical analysis. We'll cover a few of them in today's session. So one method or one way we can manage risk and technical analysis is using confirmation. And confirmation is a relatively important concept in technical analysis. And it refers to the use of additional unrelated indicators to confirm a signal. So let's say you have a system in which if price closed above the 20-day moving average, you would go ahead and enter a long position. And let's say that signal was triggered and you wanted to increase your confidence in that signal or confirm that signal. You can go ahead and look at other unrelated indicators such as momentum and volume to determine whether that signal was true or not. So there are two ways we can manage risk using confirmation. There are two ways we can use confirmation to manage risk. One way is waiting for a confirmation signal before entering a trade. And this is the example I just mentioned below or before. A second way is using fundamental analysis in conjunction with technical analysis. So let's say you looked at the company, you did all the models, and you determined that the company is undervalued and has strong growth potential. You would go ahead and look at technical indicators such as the moving average, volume, and momentum to support that analysis or refute your analysis. So this is a chart that resembles a trade where we use confirmation to enter a trade. So this blue line right here is the 20-day moving average of Apple stock. And a typical signal used by technical analysts is that if price closed above the 20-day moving average, this signals the beginning of an upward trend. And on this bar right here, we saw that the price, the right tip here, closed above the 20-day moving average. And before we entered that signal, we went ahead and looked at the RSI, which is used as a proxy for momentum. And we see that that the RSI was going the same direction as our expected as our expected trend direction. So the second way we can manage risk using technical analysis is using stops. The stop orders are orders in which a security is bought or sold at a certain price. And there are two types of stops. There is the protective stop and there is the trailing stop. So the protective stop is placed at the level of maximum loss an investor can allow in a position. And so all open positions must have a protective stop under all circumstances. And what the protective stop does is that it objectively defines your exposure to risk on that position and protects you in case of any price shock that might happen to that security you're trading. So as the protective stop is in place, the position will either trigger that stop and exit the position, or it will begin to profit. And as it begins to profit, it's where the trailing stop comes in. And the trailing stop is used most frequently to lock in gain and only placed when a certain threshold of gain is achieved. So this is a chart that resembles us using the two types of stops. So let's say you enter Apple stock at this green line right here and place your protective stop at the red line and determine that if price closed or crossed the this yellow line, which is the threshold determined by you, you would go ahead and raise the protective stop all the way to the entry price. So this is what happened with the Apple price, with the Apple stock. It crossed above the yellow line, which is the threshold, and we went ahead and raised our protective stop all the way to the entry price. And some other traders might raise it just above the entry price in order to protect their gains from losing. So the last method we can use technical analysis in order to manage risk is monitoring sentiment. And sentiment is a concept or is a process in which we analyze investors' emotion toward a market or an asset. So sentiment is a relatively important concept because if you know what investors and traders think about the market, you can determine the potential trend of that market. So we can manage risk using sentiment in two ways. We can use sentiment indicators, or we can use sentiment as a confirmation tool. So sentiment indicators, what they do is they quantitatively measure risk. And there are many types of sentiment indicators, but we will talk about the most popular ones. So the first sentiment indicator is the put-call ratio. And the put-call ratio is the ratio of puts to calls of a certain security. So if the ratio increases, it suggests that there are more puts being bought than calls, which suggests a bear market. And as the ratio is decreasing, it suggests that there are more calls being bought than puts, which suggests a bull market or an upward trend. The VIX, I'm sure most of you are familiar with the VIX. The VIX is the 30-day expected volatility of the S&P. And as the VIX increases, the expected uncertainty increases. And as the VIX decreases, the expected uncertainty decreases. And the VIX has the complete inverse relationship with the market. So as the VIX increases, the market decreases. And as the VIX decreases, the market increases. So other way we can use sentiment to manage risk is using sentiment as a confirmation tool. So let's say you have a system in which if price closed above the 20-day moving average, you would enter a long position, and let's say that signal was triggered. And you wanted to confirm or increase your confidence in that signal, you would go ahead and look at a sentiment indicator such as the put-call ratio or the VIX. And if you see that sentiment is positive, you can increase you confirmed your signal. And if you see that sentiment was negative, that weakens your signal and might suggest a trend reversal in that stock. So this is a chart that shows the relationship between the put-call ratio and the price. So we can see as the put-call ratio increases, which suggests that there are more puts being bought than calls, we can see that the market has decreased over that same period. And as the put-call ratio decreases, which suggests that there are more calls being bought than puts, we can see that the market has increased over that same period. And with our knowledge of this relationship, we can drive a system, and we can take the 10-day moving average of the put call ratio and say that if the put call ratio rises above that 10-day moving average of the put call ratio, we can enter a short position or buy a put. And if the put call ratio goes below that, the 10-day, if the put call ratio goes below that 10-day moving average, we can enter a long position or buy a call. So this was a very short lecture about technical analysis and its risk management tools. And I'm happy to take your questions if you have any.
That was fantastic. And that is something that's I've heard a lot about it over the years. I've never learned it. So it's really cool that you've taken the chance an opportunity to learn that. So what questions out there do we have from anybody? Go ahead and come on here. Lachlan, if you're still out here, Lachlan is in the Young Investor Society Club at International School Kuala Lumpur. He's asked me a number of times about technical trading, and I really don't know much about it. So any questions out there? I have a couple, but I'm going to hold mine for a moment. Let me ask you, actually, one of the students here who had to jump off earlier texted me and asked me about some of the degrees that you have. Can you talk about those and how they could get them? Is it an online system that you go to, an online school, or how did you get those degrees?
So the CMT is similar to the CFA. They just give you the curriculum and you study the curriculum and then get tested on it. So I took the CMT back in December of last year. I took the first level in December of last year, and then I took the second level in June of last year as well, and I got my CFT later that year.
How many hours of studying did it take to get those?
I think the first level I was studying for, I didn't count the hours, but I was studying for 3 months.
Oh, wow.
The other level, I think it was 5 months or something like that.
Oh, very impressive. Okay, that's great to know. Interesting. Okay, we have a question here from Aditi. He's asking, how accurate is technical analysis? And should you always use it in conjunction with fundamental analysis? So do they work well together, or are they separate?
Yeah, actually, if you use fundamental analysis alone, your signal or your analysis might be correct. But if you use it in conjunction with technical analysis, that might even support your analysis or might open your analysis to new things about the market that you might not know, because fundamental analysis does not study a price action at all, but technical analysis is built upon the study of price action. So yeah, you should always. Okay. So does algorithmic trading really works for market trends? So most of technical analysis deals with determining the trend. This is what most traders are using technical analysis try to do, is that they try to find the next trend and jump into that trend early and leave at the right time. And I think most of the algorithmic trading strategies try to find the new trend using all the mathematical models that they create. I have one other question. How important is the aspect of technical analysis? So technical analysis was built upon, so back in the early days, most technical analysts or traders, they traded based on their intuition without any testing or back testing. But as the new technologies has arrived, this had proved some tools that we're using in technical analysis. So yeah, I think this answers your question. Yeah.
That's really awesome. You know, I have one more question too for you. How long ago were you in Young Investor Society? When did you finish the program? And is there a club there in where you're at?
I'm actually still a junior. Still a junior high school student. I didn't graduate high school yet, and I joined the YIS back in I think back in June of last year, when I saw the global stock pitch competition, and I wanted to participate. So yeah.
Fantastic. Well done. Congratulations on that. So that's some great inspiration for all the other students out there as well. That's awesome that you've taken hold of that and done so well with it. We really appreciate your time today. And thank you very much for that. That was fantastic. Yeah, thank you very much. All right, we're going to wind down here. We've had a great slate of speakers. We are a little over time, but I take that as a good sign because my email address for Young Investor Society. So it's yisiskl@gmail.com. Again, I am the parent advisor here in Kuala Lumpur for the clubs that we have here. I am more than happy to answer questions or help you all out here in Asia with anything that you need. One of the things we've been working on recently in our club is the discounted cash flow analysis. And so we've been having a special Wednesday class for that as we prepare for the stock pitch competition. So if anybody's interested in learning more about that, one of the things we could consider here in Asia is a Zoom class to talk about the discounted cash flow analysis. I see that takes some extra time and some expertise in doing that. So just have a think on that if you're interested to reach out. Let me just finally finish off by thanking all of our speakers today. That was really fantastic for them to take some time out of their day, get on and talk to you. I think we learned a lot about a whole range of activities, ideas, different career paths you can choose. Keep on with your clubs. It's fantastic. We have so many young investors out here in the Asian region and the Middle East, and we will continue to have these events and opportunities to get together and share. So that's everything for today, for tonight. Again, thank you very much and have a wonderful evening. Thanks so much. I'll be on here for another minute or so. If you have any last questions, anything you want to know, feel free to put in the chat group. I'll leave it up just for a moment as everybody signs off when we close down here.
Yeah, Mark, can I ask a question, please?
Yeah, absolutely.
Could you please send the meeting recording, or could you send it to
Yes.
my email?
Yeah, absolutely. I think Ms. Tobin in the US will have a copy of that. She's the one that initiated the recording, so I'll reach out to her and make sure that she gets a copy. Yeah, thank you very much for that. I really appreciate it. What time is it there where you're at now?
I think it's almost 3 p.m.
Oh, okay. You're even earlier than India. Fantastic. Okay.
Thank you.
Yeah, we'll get that to you. Thanks so much. I'll talk to you later.
Bye.